Experts argue that the stock market will be different in 2024, and Vanguard, an asset manager with more than $7 trillion invested, predicts that it will bring us the biggest financial transformation since the 2008 financial crisis. Vanguard is one of the largest investment firms in the world, and it is also the biggest shareholder for companies like Apple, Microsoft or Nvidia. So let's see what major predictions they had in their 2024 outlook, starting with inflation. And the big question in investors' mind remains, is inflation finally defeated? Vanguard says yes, but at a higher cost than the market anticipates. They argue that right now, most of the excess inflation is because of the services sector, and it all revolves around households. In the US, besides the fiscal stimulus that helped them financially, many of these households locked low fixed-rate loans. They also accumulated meaningful cash positions. Moreover, real income grew because of a strong labor market that has added more than 225,000 jobs every month in 2023. However, Vanguard expects these factors to fade and monetary policy to become more restrictive, and they believe that this will translate into slower growth, a somewhat looser labor market, and eventually a recession. Vanguard forecasts a US GDP growth between 0.25% and 0.75%, way below the 1.8% expected by the market. As a result, the economy will experience a mild downturn, but Vanguard argues that this is necessary to finish the job of returning inflation to the 2% target. In response, the Fed will be forced to start easing policy, and the interest rate might drop below 4%. But it will not happen when the markets anticipate. The market expects the first rate cut in March and 2 rate cuts by May, but Vanguard argues that the Fed will not cut rates by the middle of the year, when the slowdown will become obvious. And before we see what these higher rates will do for equity returns, from their analysis there are 2 important things to keep in mind. Firstly, the zero rates era is officially gone, and secondly, they anticipate that rates will remain higher than they were in the last decade. They argue this is because the equilibrium real interest rate increased. The real interest rate is the difference between the federal interest rate and inflation, while the equilibrium interest rate is the level at which monetary policy would neither stimulate nor restrict an economy. Vanguard research suggests that real interest rate increased to around 1.5% today. Considering inflation will be at 2%, that makes the nominal interest rate around 3.5% going forward.
Our team believes that the neutral rate longer term is probably 3.5% or so.
They argue that this is the single most important financial development since the 2008 global financial crisis, and it has profound implications for households, businesses, and the stock market. So, what do higher interest rates mean for stocks? Vanguard's analysis shows that over the long term, equity prices trade within a fair value range that depends in part on the macroeconomic environment. In periods of low interest rates and low inflation, the level of justifiable valuations increases. That's why more than a decade of low rates and low inflation boosted the fair value estimates for equities, measured by the cyclically adjusted PE. But now things are about to change, and it seems like the market isn't ready, because Vanguard estimates that high interest rates and inflation will reverse the valuation support provided by the past era of easy money. As a result, the fair value of equities will increase, but only modestly, and Vanguard expects US multiples to decrease and forecasts a total return for the US stock market around 5.2%. On the other hand, they argue that international valuations remain more attractive since they are fairly valued. And the one thing that will decide what stocks will do well in the next years is the EPS, or the earnings per share. Vanguard predicts slower earnings growth due to a compression in corporate profit margins. If in the last 25 years the annualized earnings growth was around 7%, they expect it to fall around 4.4% in the US in the next decade. And of course, weaker earnings growth will weigh on equities returns. Earnings growth is a function of only 2 variables. On one hand, we have revenue growth and profit margins. Revenue growth is correlated with changes in economic output, which generally doesn't vary much. So the volatility in earnings growth is often driven by changes in profit margins. Since 2020, earnings grew fast because of fiscal support and declines in labor costs. But the end of the fiscal support, in conjunction with pressure from increases in labor costs will lead to lower growth for corporate earnings. Moreover, higher interest rates also squeeze profit margins for companies that carry debt on their balance sheet. So, the profit margins are key, and these are likely to fall. Slower earnings growth, coupled with likely pressure on the multiples, support the scenario with lower long-term equity returns. But there is still one factor that might help US companies, and that's the US dollar. Vanguard estimates that the US dollar is roughly 12% overvalued and will face headwinds in the future. This depreciation of the US dollar increases the value of international earnings. This is an important factor given that many of the US companies have solid international earnings. So, if in the last couple of years US stocks outperformed their international peers because of multiples expansion and US dollar strength, Vanguard estimates that both of these are likely to reverse.
When you look at where valuations are today relative to other asset classes, U.S. equities just don't look as compelling. And so when we're thinking about U.S. equities, we're expecting a 5% annualized return for the next decade. We think the international markets offer more value because valuations are more appropriately priced.
However, there are still opportunities for long-term investors, and they put equities into three categories based on their growth. Within the US market, they see the growth stocks a bit overvalued, while in large caps there might be opportunities since these are fairly valued. Moreover, US value stocks are more attractive than they have been since late 2021, as these seem to be fairly valued as well. However, the small caps are probably the most undervalued class of assets. A good way to get exposure to US small caps is to invest in the Russell 2000 index. This offers exposure to many industries and offers a good level of diversification. Another small cap index is the S&P 600, which is built with a profitability filter, so the stocks included here generally have a lower degree of risk. However, please keep in mind that both the Russell 2000 and S&P 600 underperformed the S&P 500 in the last 5 years, so it's probably best to keep investing in individual stocks. But for now, Vanguard shows that they are underinvested in equities as they favor a larger allocation to bonds for a more attractive risk-reward. To sum up, 2024 will represent a pivotal year for the stock market as higher interest rates are here to stay. Vanguard anticipates a mild recession happening and rate cuts coming in the second half of the year. In spite of the US market being overvalued, these events will still create opportunities in the stock market, so subscribe to this channel and let's find them together.